Hello everyone. We want to take a look at our risk model today. We start off with taking a look at some of the major US market indices. So obviously Friday was a distribution day for all of the major US market indices, for the Dow Jones, for the S&P 500, the Qs, the Russell. So they all added another distribution day now in a series of distribution days over the last 2 to 3 weeks. So that's certainly a red flag for us now that underlines increased institutional selling. So that's not a good sign. This is one of the red flags we see in this market for quite some time now. The other indicator we normally look at is the up and down volume for the major market indices. Now what you can see is that the up down volume is below 1 for the Russell. It's just about okay for the Qs. Also same for the Dow Jones and the S&P 500 now. But overall it's looking worse versus a couple of weeks ago now. So the overall trend is going downwards. So I'd say the up and down volume indicator for our risk model is just about still in the green range here. Looking at the new highs and lows for the Nasdaq, so there's a clear trend to the negative. So obviously Friday was a bad day at the US stock market now, and the new highs, the number of new lows significantly higher than the number of new highs. And you can see that this is a trend going on for the last 5 to 10 trading days. So that's certainly a red flag. The other thing that we normally look at now is the number of stocks above their 200-day moving average. This indicator now shows that this number is below 50%. So that's another red flag. Now we want to, in a healthy market, you would see a stable uptrend, first of all markets, major market indicators in combination with a number here, a percentage range significantly higher than 50. The other concerning indicator is the advanced decline line, which topped on November 12th and is going down ever since. So normally what we see is that the advanced decline line tops before the major market indices top and enter a new downtrend. Now this could be a pretty negative sign now, and could be an indicator that we are just about to enter a new downtrend of the overall stock market here. So this adds another red flag. We also normally look at the volatility now, because now due to our trading strategy, high volatility is not good at all for us now, because then normally higher number of stop losses are being hit. And Friday, obviously, not due to the COVID news from South Africa, but also it also looks like this new South African variant has been landed in Europe now. So this caused a lot of nervousness in the US stock market, and volatility peaked. It actually peaked very close to the critical range of 30 here. So this is at least another orange flag to be listed here. So the long-term bond yields now, or the US 10-year, looks okay. Now this is peaked down on Friday. Now the US markets analysts, now they consider the 1.7 as a critical threshold here. So as long as we stay below the 1.7% range, now we are still okay now. And while we have been getting close to this critical threshold here now, so it peaked down, so that's okay. looks okay in this regard now. So let's look at the weekly review of the market sentiment, the bulls versus bears. Now the critical range here is 60% bullish. Now this is a contrarian indicator. We want to, ideally we would see the bulls being in the low range here. Now, so as long as we are in the range below 60, we are kind of okay. Now, but it looked like the sentiment got more bullish again, which is another cause for caution here. Other than that, now what we also always consider is performance of our stock portfolio. So this was neutral to negative last week. Now, this is a very important indicator for us. So overall, situation at the stock market overall, I would say, does not look good. So if we take a look at the overall risk model rating, we changed that from neutral last week. This changed from neutral to a sell signal, and our recommendation at the moment is to be either fully in cash now or only take a very few pilot positions. So overall, our recommendation would be to be invested either fully in cash or certainly less than 30%. So we already now downgraded our risk model last week. So if you followed that, you would have been 30 to 50% invested. So hopefully now your portfolio did not get a too hard hit on Friday. But after the Friday performance of the stock market, now we changed that to a sell signal. So for now, I'd say now we need to be very cautious. Now we need to be well aware of the risk associated with this bad news around COVID. Now this could be short-lived. Now we could bounce back in the next couple of days, but we don't know, and this could also be the start of a major correction, a more significant correction here. And also to be on the safe side, not just be very careful and certainly there's no reason at all to be aggressive at this point. So I hope this has been helpful, and talk to you next time again.